All right, so today I wanted to talk about a company in the tech sector that I think is very interesting. And this is Universal Display Corporation. They're basically the OLED and QLED. They're the ones that make all that. Also for, I believe, OLED displays can be used in the mobile phone, television, wearable, tablet, notebook, computer, augmented reality, virtual reality, and automotive products. Um, so again, they also have a lot of patents on a lot of this kind of stuff. So again, if you're looking for a company that has a moat, although they're not necessarily the best example of it, I think that they're a decent example of it. But the one thing that's very interesting about this company is that their 5-year dividend compound annual growth is 58%, which is utterly insane. It is only just over 1%. The payout ratio is about 30%, so they could probably pay about a 3.5% dividend. Um, but again, you look at it in 2016, they started paying a dividend 12 cents. Um, Lately, they're up to $1.20. So again, this is a company that it's growing its dividend very, very, very fast, like very fast. So that's one. And again, I'm not necessarily the biggest fan of this company. I do own a small position. I do think it is a little bit speculative, but given that dividend growth and given the fact that it has a decent moat, that's why I do like this company. Again, if we get into its financials here. Um, let's get right into it. They are issuing a small amount of shares every year, which again, I don't like, but they're not taking on any new debt. This is a company that hasn't taken on any debt for a long time. If we look at its free cash flow, um, it is, it hasn't gone that far. Like from 2017, 103 million, 100, sorry, um, to 2021, again, the last quarter. This is a trailing 12. This is a yearly thing. So 147. I'd like to see the 2022 numbers. They should be coming out fairly soon. Again, they peaked in 2019, but it looks like they're on their way to getting the numbers back here. Although if we look at the profitability numbers, the metrics there, they are pretty good. I mean, you know, always had a very strong gross margin, very strong operating margin, strong net margin. Free cash flow margin has been decent as well, at least in the last 5 years. 2016 was an oddly bad year for whatever reason, but the last 5 years it's been at least 26% every year. Again, I think that this has been hurt a little bit as of late. Again, good return on equity as well. Not great, but solid. Book value per share has gone up every year since 2012. Free cash flow per share is probably one of the main things we're worried about here. Again, it's not a great uptrend, but I think it's going to trend up over the long run because the demand for the products they sell is always going to be there. Now, it's going to be cyclical, but it's always going to be there, right? And again, if we get into some other numbers here, earnings are still projected to go up next year, right? And considering it's looking like we very well could be in a global recession, that is a good sign, right? In that earnings are still projected to go up. Operating cash flow is the one thing that's going down, although revenue, gross profit, it's still going up. Again, another probably arguably the most attractive thing about this company is that the balance sheet is very, very, very good, like almost as good as you'll see, in that the current ratio is at 7. They are debt free. They have way more cash than total liabilities. Again, the profitability numbers are very good as well. The returns are very good as well. Another concerning thing here is the 5-year stock growth is actually negative, but that's because it's gone down a lot this year, like a lot of companies. It is still a little bit expensive, I would argue. But again, this is a tech company, right? This is not a consumer staples company or something like that. This is a tech company. So again, in my opinion, I would prefer to get it below $100, which again is close to its 52-week low at just under 90. I would prefer to get it under $100. But again, if you're buying this company, I think that it is a little bit speculative, but you're also buying it considering I think the business is pretty long term. I think it's going to be pretty steady, although I think it's going to be volatile over that time. But again, does anybody really think that the demand for TVs, computers, phones, that kind of stuff is going to go down over the long run? Like that's not going to happen, right? And given that that's not going to happen, we know that a company like this is going to benefit, right? We know that a company like this is going to benefit from that. And again, this is only a $5.2 billion company. Like, they have a lot of room to grow. Like, they have a lot of room to grow, in my opinion. Like I said, the PE 27, it is a little bit expensive, right? It is definitely a little bit expensive, but I would look at, if we get a recession and this company comes down even more, like I said, if you could get it like 90 in the 80s, I think that that's a screaming deal. But again, over the long run, again, last year, this company peaked out at like $260. Like, that's the potential that this company has. Within the next 5 years, 3 years, maybe 2 years, this company is going to get back there, right? So this is the company, I think you're going to double your money. Again, my opinion, do your own due diligence, but I think you're going to double your money in the next 3 to 5 years. Which, again, if you look at the S&P, that's doubling every, 7, 8, 10 years. Right? So again, this is a company that over the long run, I think it's going to beat the market, right? And again, when you're looking for good companies, you're looking for companies that are very profitable, they're generating good returns, they don't have excessive debt, which again this company is a very good balance sheet. And again, when you're looking at tech companies, a big problem with a lot of tech companies is, number one, they're not making money. Again, if a company's not making money, they are very speculative. I don't care. There's no debate on that. If they're not making money, they're very speculative. So again, you want companies that are making money, that you can look at the tangible things that are going on and say, hey, this is how profitable this company is. This is if they're paying dividends, the debt, all that kind of stuff, right? And again, like I say, you want to have a very clear picture as to why you're buying this company, right? And when it comes to this company, I like it because it has a decent moat. Again, it's not great by any means, but it has a decent one. It's paying a dividend. It's growing that dividend very fast, right? Again, if you buy this company at $90, $100, and they continue to raise that dividend over time, 10 years from now, you could have a 5-10% dividend yield on cost. You could have literally 10x'd your yield on cost if you buy this company within the next year or two. Right? And again, like I say, do your own due diligence, all that kind of stuff. Again, my opinion here, everything. But again, you want to also buy companies that have very good balance sheets, because if we get a recession, which we probably already are in, but it's just a matter of how bad it's going to be, the companies that have very strong balance sheets are the ones that are going to get out of it the best. Because if you get a recession, earnings are going to come down, and when earnings come down, well, what happens to the companies that are the least profitable, that have the weakest balance sheets? The only way they're going to stay in business is by taking on debt, by issuing shares, and that's never a good recipe for success, right? So again, like I said, I'm not necessarily the biggest fan of this company, although I think that it is a perfect example of a company that you could 5x your money in the next 10 years. Like, I don't think that that's out of the question, right? And I'm including the dividend in that, right? So again, if you're looking for a company that's, I think that it's somewhat speculative, because again, the earnings yield is a little concerning, that it's only 3.66%. I'd prefer that number to be 1 or 2% higher. But again, also you look at analysts as well, right? Analysts are bullish on this company. Now, again, there is one guy, it looks like that's pretty bearish. But again, if you can get this company at 82, I think that just provides a very good buying opportunity, right? And this is another thing that not enough people are talking about with this whole recession talk that's going on lately. It's like, regardless of what happens in the market over the next year or so, if we get a recession, all that does is provide a good buying opportunity for a lot of these companies, right? And this is the thing that novice investors continue to get wrong on, right? In that if we get a recession, do you think Warren Buffett's going to be panicking and sell everything, all that garbage? Or is he going to be buying the best companies, the companies that he thinks provide a very good buying opportunity? Of course he's going to be buying, right? He's going to be, I mean, obviously, I imagine he's not doing a whole lot literally these days, but again, the best investors, when you get those recessions, that's when they're buying. That's when they're looking to buy. Again, you want to buy panic and sell hysteria, right? That's the key to long-term success. So anyway, just an example of a company that again, I think is a solid company. Not saying that it's something that should be a large percentage of your portfolio by any means, but I think that it's a good company to have, in my opinion, right? So anyway, that's what I wanted to talk about today. If you liked the video, hit that like and subscribe, and stay tuned for more.